Welcome traders, welcome VIP members. This is Chris from the tradingmentors.com. Hope you are well. We await the FOMC tonight, so the markets will be flat as a pancake. That's perfectly normal. So take the day off, go and play golf, whatever you do. But one of the requests that's come in from one of my long-standing VIP members is how can we trade mid-term charts using a technique with outside bars. We call them outside bars, and I'll explain that in a bit of detail. And how can we get more signals more often with some nice price action? So that's what I'm going to go through this. I'm going to show you one technique where if you have the price action charts, and most of you do by now, and the advanced pro charts, if you're on those, then of course you'll have everything anyway. But let me just cover a few things first. Now I've got the definition of a bullish order block, and you might see some green buttons and you might see some red buttons, and I want to see and explain why they're so important and how to use them and how to benefit and how to profit. So just have a look at this chart for 1 minute, and I'm going to scan back and see where you think there might have been some great trading opportunities. This is a 1 hour chart on the pound yen. Pound yen is quite a popular one to trade, so it's got quite a lot of volume going through it, which is fantastic. Now, I'm not a overactive trader. In other words, I'm a position trader. I prefer the 4 hour chart. I prefer the daily chart, and I then prefer to go and play golf. That's what I do, and I've done that for 30 years. So let me scan back and just see where you think you might have bought or where you might have sold. Okay, so that's just gives you a feel of what's happening here on the 1 hour chart. So first thing is, one of the rules which is really important is that you want to see an outside bar. Let me define that. So an outside bar, got my smiley face ready. So an outside bar is defined, if you can see this channel here, I've got it as dark as I can. An outside bar is indicated once the price has gone too far, too quickly. Too far, too quickly. Oh, by the way, you can see that it's in a downtrend anyway, so this is just a spike. So once we get that position, and we can see another one there, let's just go over a few. Another one there. Another one there. Another one there. None there. Another one there. Really important one. And so on and so forth. So one of the things what I'm going to show you and teach you and coach you is that this technique can be used on the 1 hour chart, and you can scan all the currencies in about 10 minutes. That's it. And you will know straight away whether there's likely to be any kind of breakout to the upside or the downside. And I'll also show you how to set alerts. If they're not quite ready yet, they may be ready in an hour or so, and you can get an email sent to you, sent to your email, an alert sent to your email, so you can actually have a look at the chart even on your mobile. So outside bars, really, really important. Number one, you must have those. That's the major rule. The other rule here, if you can see this in blue, is my a demand area, high liquidity, as I often call it, area, and it goes back several months. And so the longer it goes back, the more significant it is. If it's been hit once and then twice, that's even more significant, a double bottom. And so therefore that's important. Now we're not seeing any price action today because we got the FOMC decision today. If you're watching this down a few months down the line, nothing changes. Every day is the same day. So outside bars are really important. Now the important thing, as with the outside bars, they have to be hitting convergence, what we call convergence. And so therefore, once we see that the price is moving outside the bar and hitting a demand area, demand area, this liquidity zone here, then you have a chance of actually getting in. And I'll show you the technique to get in a moment. And I'll go into a little bit more detail on the lower time frame to show you a good entry point where you can get in. And I'll align the chart with this one so that you can use information if you have the charts. Now, the charts are not free because these have been tested over many, many years, and we know they work. So the other thing to note here is these red lines and these green lines. This is automatically on your chart confirming negative divergence, which is this red one. Negative simply means it goes red, and in other words, the price is achieving a high, but an oscillator down below, don't need to see that, is achieving lower lows. And the opposite applies with a bullish divergence. Hourly chart, don't forget, you're in no rush. Bullish divergence. So let's see this one. This is particularly attractive as well as this one because, number one, we have bullish divergence automatically drawn on your chart. You don't need to spend time looking for it and hunting for it. It's all done for you. This is the value of the charts. Outside bar, happy days. And then, of course, hitting a major demand area. So what is the trigger? Now you might see these green dots. These are bullish order box automatically given to you on your chart. Nothing else is needed. And you just simply recognize negative divergence, recognize positive divergence, recognize outside bar on demand, and then you wait for the green dot to appear on the next candle. So in this instance here, and when I'm at the chart, actually I don't mind sending this as a Forex signal, the Forex group. So to work out your stop, you just go to the swing low. And you can actually see the target already. But what I would do is you can go for that, which is going to take longer, 321 pips, or you can go for this one. Notice here that it coincides with the previous high here, and there's a bearish order block there. Cut across, so breaker structure there. So breaker structure happened, and the price has gone up and now gone sideways, and we do expect this to go down in the very near future. So what does this mean in terms of profit? So we can say safely that here there's 200 pips with a 73 pip risk, so 2.82 risk to reward. We could say that, okay, there's no outside bar here, but there might be sufficient information here to say there's negative divergence in a downtrend. We could draw a trend line here and it will coincide with that. And then we've got a bearish order block in red. So let's have a look at that. Don't forget, if you want to be in the VIP members room, please join us. I do regular events and training and coaching. And we can see that we've already got the target in mind. So we could say here, for instance, there's the swing high, 74 pip risk and 217 pips target. Would have got hit quite quickly within 24 hours. This is a good one. So we can say that yes, we have positive divergence, green line. We have outside bar, here, on demand, and then a green buy signal on the bullish order block. So just buy it on the green candle. Swing low is quite high here, this one. I would be, because it's such a wide stop, 110 pips, let's say, I'd be hesitant with that. But nonetheless, we can see that the support line is there. So 1.5 would be the maximum you get out of that, because if you've got 110, you need 220 for a 2 to 1, which is way up there. Now, possibly it could have done that, and eventually it did. So it depends how far you want to go and how long you're going to wait for it to hit target. So what I would say is, if you have a much wider stop than normal, i.e. normally 50 to 70 pips, and you've got 110 pips, you need to lower your lot size, of course. But because it's so wide, maybe the market's not going to achieve 2 to 1. So 1.5 is sufficient. That's 168 pips. This is nice. Now we have a bearish order block here as it breaks down. That on its own, I would say, is not tradable for me, because you're not going to trade every dot that you see. That doesn't make any sense. But what you are going to do is you're going to see the outside bar on supply this time. The supply is only in yellow, mine's in yellow. And then you've got the red sell signal on a bearish order block. Okay, so let's have a look at that. So somewhere around there, let's say. So your stop is the swing high, 63 pips this time. And you can certainly go for 2 to 1, can't you? Easily 134 pips, but you already have a target set. And you've got a nice tight stop. So you can go for the target that's already set on your chart, 372 pips. Another one here. I will go into the tighter time frame if you like in the next few minutes, but outside bar into supply area already established, and the price gives way. Depends how fast the market is, of course. If you're down here, you don't want to be doing it. If you're up here, you do want to be doing it. So 114. So that kind of wide stop, 1.5, is going to be the maximum of 174 pips. See if we can spot any more. Well, there we are. Outside bar on supply. The price gives way big time there, doesn't it? But nonetheless, you've got some support lines you can aim for on your left. So if you want to work out what your target is, just look left. So again, outside bar on supply. Somewhere around there. So I think you get the idea here. Very, very simple way to trade, which you just scan the markets across the board and just see where the price is. Is it an outside bar? Is it hitting demand or supply? Do we have negative or positive divergence, which tends to drive the market better? And then do we have a bullish OB or a bearish OB, which gives us a signal? But what I'll do now is just go deeper into the market. If you wish, you don't have to use it. You can just use this one chart forever. Okay? And if I spot a trade like this during my sessions, I usually trade during the New York session for a couple of hours. That's my time. I'm up at 6, do a quick scan of the markets, let the VIP members know what's going on, and then I usually play golf in the morning, so, or whatever. So my time is the New York session. But a fantastic way to trade, very, very easy and very easy to follow, whether you're advanced or whether you're a beginner. So let's dive in. So this is optional, and this on the right is now the 15-minute chart, and on the left is the 1-hour chart. Just a reminder, looking for outside bars on supply with positive or negative divergence. They're the keys: the convergence, the divergence, the change of character, the break of structure. They're the things we're looking for. Okay, so far so good. And so let me just go over this now. If you have the Advanced Pro charts or the price action charts, you'll know these settings. If there's anything you're not quite sure about, just drop me a line and I'll explain it and we'll get you on track. So let me just align these so you can see the curves. If I go left and right, it lines up. Okay, so this is the change of character. So the price is in a downtrend temporarily, and then you're looking for a change of character, in other words, from a downtrend to an uptrend, and you're looking for an outside bar, which you have that. If I do the cursor there, you can see that. And the convergence has happened. All three events have happened. And then you've got change of character. So the change of character is dictated by a green candle, in this case. And so therefore we can safely say that has converted. And so we can go in there, we can put a stop there, and we've got our target up there. We've already calculated it. We don't need to calculate anything on the 15-minute chart. Now, in the terms of managing the position, because it's a short-term chart compared to a 4-hour, then of course you might want to pop back later on in a couple of hours and move your stop. You can easily do that by using this tool here. And so you just move your stop to here, 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 and of course it hits the target up there somewhere, and you have banked 170 pips or whatever it is. Doesn't matter what it is at this stage, depends where you get in. But the important thing is, a couple of important things is your stop is in the right place. Okay, in that place there, green, below the green line, and then you just move it up until, of course, within a couple of hours or within about an hour, you are actually break even, and then you can move on to the next one. Let's look at a few more examples, and you might like this way of trading. So here is an example. If I line this up here, we had a bearish order block with divergence. Not quite sufficient enough to be a trade from my perspective, but you do have an outside bar as well. So, but not in the supply zone. I would prefer to see this happening in the supply zone, but it doesn't always happen like that. So it's your choice whether you trade this. So let's have a look at this as an example. Stop, swing low. We can say that, yeah, that would not have been a good trade. It's not sufficient enough. First of all, the number one thing is there's not enough profit in it to actually get 1.5 even to it, let alone to get 2. If you go for 2 times, that there's not enough oomph behind it, and it's not hit a supply zone, which is going to drive it lower. The better ones are when it hits the supply zone. Let's go back to this one here, the previous one. You can see the cursor going with it. There's one there. Could have traded that, not off a supply zone, but nonetheless would have turned out okay. But let's have a look at this here. So there we are. So in this instance here, we can say that the price broke here, stop there. Now that's 100 pips. This is a bit too much for me, but you'll be going for 1.5. That would not have got hit. That would not have got hit. So in this instance here, you would actually be trading this. So you'd have a break-even trade, probably break even at that stage. But certainly as the price moves into this area, then you don't want to be in it anyway. Okay, so that's really important. Let's go back to this one. Now some of them are going to be massive in terms of profits, and some of them not going to be so much. That's markets, that's just the way it goes. So we have on the left, we have the price hitting an order block. We have an outside bar, perfect. And then we have a red signal to sell on a bearish order block. We then have a change of character to here. And we can place our stop at the previous height. Can go higher, but the red line is sufficient, 68 pips. And you can go easily 2 to 1 with that one. Or have a much bigger target to the bottom there, which makes sense. See the left, that's the demand area. And you have 329 pips. Now the managing of this is simple. Move your stop, and you might get stopped out there if you're doing that. But nonetheless, it would have hit target as well. So a fantastic way to trade for me. This is sufficient. This is sufficient if I was trading this way. Just wait for the outside bars. Converging with demand or supply. Converging with divergence. Positive or negative. And then you're just waiting for the bullish or bearish order block. If you have any questions, please let me know.